Hello, everyone. Welcome back to another edition of the Weekend Charts. Special guest today, back for, I believe, the fourth time this year, Jamie. Jamie Batmer, Chief Investment Officer at Kira Creative Planning. Welcome back to the show, Jamie.
Hey, Charlie, thanks a lot for having me back. Appreciate it, buddy.
A lot going on in the markets. But first, if you're watching this on YouTube, hit that subscribe button for a lot more content just like it. A lot of big content coming in the next few weeks. So make sure you subscribe to the channel. Jamie, hopefully you're comfortable with some hot topics today. I'm going to really ask you some difficult questions. I want to get your honest take on a lot of stuff that's going on in the markets. Number one, will everything change over the next 10 years? A lot's going to change, but here we're talking about the investment world. So we're going to dig into what's happened the last 10 years and get your take on the next 10. The AI-driven multiple expansion, obviously, huge story. What AI is going to do for the economy, for the markets. Expectations are a little bit frothy here. I want to get your take on where that sits today and if you agree with those current valuations. Number three, reaching for yield like it's 2007. We're going to talk about credit markets. Number four, the rise of the bond vigilantes. I don't know if you have the national debt clock on your screen every day like I do, ticking higher, probably, hopefully not, Jamie, but just a little bit higher in the last few months, if you haven't noticed. So we're going to talk about that. Number five, stock picking is hard, always hard. Latest example would be Netflix. And we're going to end, as we always do, with something positive. Are workers today better off than 50 years ago? I think I know what your answer to that question is going to be, but we'll talk about that and some good news, obviously, for the average American worker over the last 50 years. Okay, number one, will everything change over the next 10 years? First, let's talk about what's happened in the last 10 here, Jamie. It's been dominant performance by U.S. large cap stocks, 13.4% for the S&P 500, but in particular, large cap growth stocks at the top of the list here, 16.5% per year over the last 10 years. And then you see the returns go down from there. Small caps at around 10%, value 9.2, you got REITs 7.7, international, looking at MSCI World ex-US 6.2, emerging markets 4.4, and bonds down at the bottom 1.8% per year. Were you expecting this 10 years ago, Jamie?
Well, we expected to not try and anticipate what the next 10 years were going to be. Our crystal ball remains very fuzzy. Can't even see the debt clock behind it. It's so fuzzy, Charlie. But, really, it's just, it's funny. You circle back. Okay, yeah, this is what's happened in the last 10 years. But you could almost just reverse engineer this chart for the prior decade or the first decade of the new millennium. And so first off, let's say the MSCI World, everything excluding the United States, 6% return, 6.2% annualized returns, below long-term averages, but not catastrophic by any means. Again, yes, when you're comparing it to high teens, of course, but on absolute term, again, not catastrophic. But right to the right of that, I think the best example is emerging markets being kind of the weaker player. Obviously, the challenges in China, a lot of the world, Russia, of course. But 10 years ago, find some old VHS tapes or whatever from 10 years ago. People that were trying to pretend what the future was going to hold, all they were pitching was the BRICS, right? BRICS this, BRICS that, BRICS that, BRICS, Brazil, Russia, India, China, because, they've done really well the last decade. Even think about that comment now. Imagine walking into a client conversation. Let's talk about the R in BRICS. Let's talk about investing in Russia. Can't even be done. So again, just always avoid the hot dot. And yes, yeah. Typically there's reversion mean.
Has R been replaced? I mean, or is it just BIC now? I don't know.
I don't know.
The acronym is just gone because nobody wants anything to do with emerging markets, pretty much.
Usually, when an acronym starts to form, like with the Mag 7 or something, that's when you gotta watch things. But all that means is people are excited about it, and so again, any hot dot usually fizzles out, be it a dance craze or investment craze.
Okay, so the past is the past, right? We know what's done well. That's easy to register, and everyone in hindsight will say they were super bullish, right, on growth stocks and tech 10 years ago, but always the question is, well, what's going to happen going forward? That investing is all about the future, not the past. And so Vanguard, one of the biggest companies out there, investment companies, trillions of dollars in assets. They put together these return projections every quarter. This is their latest estimate in terms of the equity markets over the next 10 years per year. So they're looking at US equities at around 4% per year. They're saying small caps are going to be a little bit better than large caps. They're saying that global is going to be better than US. And they're going to say emerging markets are going to be better than they were and outperform the US as well. And on the bond side, they're saying much better than the last 10 years. They're saying about 5% per year for the aggregate bond market. Now, I want to put the two together here and get your take on this chart here. It seems to me, if I'm looking at this correctly, what they're essentially saying is what's happened in the last 10 years not going to be repeated. We're going to see a reversion to the mean in some sense, where you're going to see large cap growth stocks underperform by the most. They're going to do 1.1% per year over the next decade. You're going to see large cap US stocks 4%, small caps better than large caps at 6%, and value beating growth 5.7%. And then on the international side, you're going to have 7.9% returns there, and even emerging markets 6.7. And then the bond market, they're saying, going to be higher there, as we'll talk about, a little bit easier to project returns. Obviously, yields much higher than they were 10 years ago. But tell me if I'm interpreting this correctly. Essentially, they're saying there's going to be a mean reversion in terms of valuation across the board.
Well, not to pick on Vanguard, because again, we love a lot of the core principles, what Vanguard brought to the investment universe. I mean, Jack Bogle was an innovator in kind of the low cost efficient indexed investing. But maybe that, yes, we believe in mean reversion too. Absolutely, what they're saying. This might be the next 10 years. It might happen in the next year. It might take 100 years for that mean reversion to occur. And so making sweeping adjustments to an underlying asset allocation based on this, like if you say a client came to us and said, I'm putting all my money in the MSCI World because it's going to make 7.9% over the next 10 years compared to 1.1% for large cap growth stocks, we would say, please, 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 absolutely don't do that. Because again, you're trying to look into the future. And this is why you have all these assets, regardless, trying to have a global portfolio based upon like global market capitalization. So that kind of takes care of it for you. As things ebb and flow, kind of you expand or contract, you expand in the technology or decompress from energy, or inversely, as these dynamics take care of themselves. But overall, yes, you can't kind of peg it, but it just reinforces you stay diversified, not try and chase. There is a mean reversion that typically occurs, but as has been the case, and will even by this data overall, you're still rewarded more typically for being an owner versus being a lender. But next 10 years, the only near guarantee we can make, Charlie, is the near guarantee that the projections they're making are going to be inaccurate, just like anyone's projections they try and extrapolate over a 10-year period.
And the reason for that, right, of course, is it's so difficult to predict what investors' behavior is going to be 10 years from now. Just like that multiple expansion, as we're going to talk about in a little bit, was very hard to predict over the last 10 years. Whether we get that contraction over the 10 years, as you said, or it takes longer or it happens shorter, that's the part we don't know. But I want to come with a concrete example here and get your take. Someone comes to you and their portfolio is entirely large cap growth stocks, and they've done extremely well over the last 10 years, and they're concentrated in the biggest stocks that have done well. How do you convince them that from a risk management perspective, forget about Vanguard's forecast here, that is a bet that maybe they shouldn't be making, particularly here after this enormous run?
I mean, just show them the historical empirical data that drives all of our decision making. That the first decade, new millennium, that investment, $1 million investment there would have lost $333,000 over a full 10-year period. And so making sure that they're kind of focused on the facts instead of, and it's hard. It's hard. A proper sell discipline is oftentimes harder than a proper buy discipline. But just let the historical facts, instead of some kind of irrational exuberance of the most recent momentum, drive decision making. And that's what we try and do to justify diversification, not to take away these glorious assets that have had all this growth for somebody. Hey, take advantage. You never go broke taking gains and diversifying. Amazon is the example. Yes, if Charlie, if you would only had $1 invested in Amazon in 1990, you'd be worth $44 billion today, right? Whatever they say. But the idea is, At one point, you would have had to have survived a nearly 98% decline in the value of that stock. If you could actually have the intestinal fortitude to keep calm and carry on, if all your eggs were in that basket, good for you, but most people didn't. And that's by spreading the risk, being blessed with the gains you have, moving it around, because the only consistency is absolute lack of consistency.
So you talk about empirical data. Does it suggest that value should do better from here? Is creative planning making that bet in its portfolios? Would you think the odds favor value going forward from here, or
Again,
small cap value?
the odds are, but the odds, say there's just, a decent chance that it's not going to play out either. We really try and take that decision making out of the process. That is why we're not running from the value holdings that make up the broad indexes that we invest in. It's like we're not running to the growth dynamics. The underlying construction of these large indexes, the S&P 500, it ebbs and flows with the dominance of these growth players or value players. But again, love the concept of investing, not the individual names. The last tech bubble we had with growth dominating, Cisco was the NVIDIA of the moment. Cisco is still down 70% from its high, but the S&P 500 that it momentarily was a top dog in, it's gone up hundreds of percent since then. And so again, don't use history as a guide. It doesn't necessarily repeat itself, but it rhymes time and time again.
Okay, so I want to go back 10 years ago and just evaluate how Vanguard did with their projections back then, right? They said US stocks 4 to 6%, so 5% return. We saw S&P did 13%. International, they said 5 to 7, so 6 right in the middle. They were pretty much on target there. Bonds, they said 2 to 4, so 3% in the middle. Bonds definitely did worse, we know, as interest rates had that big spike. And if we look at small caps versus large caps, 10 years ago, they suggested small caps are going to do better than large caps. They were looking at 6% for small caps, 5% for large caps. Obviously, large caps ended up outperforming. Both did better than the projections there. So that just goes to exactly pretty much what you were saying, how difficult it is. And 10 years ago, they were making, interestingly, Jamie, similar arguments as today. I would say they have a better case today for talking about high market valuations, as we're going to talk about in a little bit. But they were talking about that back in 2014 when they were saying back then, actually, that international stocks were going to do better because they had greater growth opportunities than the U.S. They were thinking moderate growth expectations, and boy, did that not occur, right?
I was talking to a firm that we invest with on the private market side and the private equity side. They said going into this year, 16 of the 17 leading economists they spoke with said we were going to go into recession in 2024. So only one out of that. And he said, yeah, that one economist reinforces all the time how they got it right and no one else did. Well, they were still guessing just like anyone else. Their guess happened to come true. That's why we avoid the guessing game, and the math works out over the long run.
100%. Okay. So enormous eight here. I just want to stop for a second, Jamie, because I think we get lost in this because we're kind of become immune to these ridiculous gains. And I want to caution anyone who's watching this. Yeah, we don't know what's going to happen over the next 10 years, but I'm going to bet pretty strongly this won't happen again. You're talking about 31,000% gain for NVIDIA, Tesla, 1,500%, Netflix, 1,200+%, Amazon 1,200%, Microsoft almost 1,000%, Apple 900%, the market overall 252%, so well above what it tends to do in a 10-year period. Are you comfortable saying, Jamie, that 1,000% returns in the biggest stocks? These were the biggest stocks 10 years ago, so this is highly unusual that we have some of the same. NVIDIA is obviously a new player, but Amazon, Apple, Google, and Microsoft were the biggest stocks 10 years ago. They're still the big. Are you comfortable saying very, very low likelihood we're going to see anywhere near these types of returns? If we were, things like Apple and Amazon will be bigger than the U.S. economy if we saw a similar gain over the next 10 years.
Yeah, it seems like it could be tough to manifest itself, but we don't know. Will there be a stock on the left like that within? But will the name probably be something different than NVIDIA? Absolutely. What actually really bothers me, Charlie, is that this chart would somehow make someone be embarrassed by having a 250+% return over the last 10 years. Again, so make sure not, comparing yourself, to the other, the other constituents. Focus on what's right. Having a well-diversified strategy that's returning hundreds of percents is what's going to win the day. Because again, it could have just as easily been Cisco at some point in that regard. If you got in on day one, went public, good for you. But right now, you're still licking your wounds with a 70% loss. So yeah, again, it's all about the graph sizing, how the XY axes are. And I know you had to do it to
And
get on the
Nvidia really screws it up. I mean,
Yeah,
you're
but
talking
like,
talking about
yeah,
sample size of one. I mean, it's literally what I always call it is the Caitlin Clark of the stock market. It's so far ahead of
yeah,
everyone else. It's unbelievable. But I think the broader point on this chart is in order to guarantee getting that 250, guarantee getting that gain and getting the returns of all these big winners, you have to own everything, right? So if you don't own everything, you might miss out on a few of these stocks, which is what active managers actually do. And you see the list of active managers picking stocks that beat the S&P 500 over the last 10 years, almost no one, right? It's like, and for this reason, because they didn't get Nvidia early. They didn't wait it as big as it actually should have been, right? The market actually overall did better than most of the active stock pickers, probably 95 to 99% over the last 10 years. Okay. With that, if you're thinking about your own portfolio, what should you do over the next 10 years? We're going to take a look at your entire portfolio, give you our unbiased view on what you should be doing over the next 10 years. So go to creativeplanning.com/Charlie. Get your free wealth path analysis. With that, again, we're going to be looking through your portfolio, making sure it's diversified, and more importantly, right, Jamie, making sure it meets your needs and goals for the future. That's really objective number one. We're going to do a retirement roadmap for you. Are you on the right path? Proactive tax strategies. Tax doesn't get a lot of attention, but it really should. So are you taking advantage of tax loss harvesting, asset location, optimal charitable giving? And lastly, an insurance and estate planning review. Are your assets protected? And do you have an estate plan that you're happy with? So reach out today, creativeplanning.com. We're in all 50 states, 325 billion in assets under management and advisement. We're here to help. If you look in this top corner here, you could probably see Jamie in that
wow.
corner office up there. All right.
I think the basement, bottom left,
Oh,
not
down
top
here.
right.
Okay.
Bottom left, not top right.
One of those two. Okay. Number two here, Jamie, the AI driven multiple expansion. I'm going to set this up for you. This is what's happened this year. I know you predicted this, but no other major CIOs predicted this. 47 all-time highs already this year. Unbelievable year. We're well above the average year, 24% year to date. Only 1995 and 1997 have better starts since 1990. Over the last year, 37% gain. If you remember, the October correction last year just shot up after that, and we really never looked back. 37% gain. But the last decade, so we're talking about that last 10 years, this is the breakdown here. This is what I want your opinion on. S&P 500 sales up 68%, earnings 92%. S&P 500 index up a little bit more than those underlying fundamentals, 202%. And what that has caused, as you might have guessed, is valuations to increase. So no question, earnings are higher. No question, revenues are higher. But the price increases in terms of stocks have outpaced both of those. And we're now seeing the highest price to peak earnings ratio since 2000 at 25.8. So before I tell you what the justification for this high multiple is, how do you look at valuation multiples? Do you think being 50% above the historical median, do you think that's a cause for concern for U.S. equity investors?
Well, first off, Charlie, thanks for saying I was the only chief investment officer to get it right. The big asterisk next to that is if I got it right because I abstained from voting or I abstained from pretending like I knew what the future would hold. Um,
Don't
so
sell yourself. You were pretty bullish early in the year when we talked.
well,
So
hey,
are
thank
you
you.
you're not just a perma bull. So I mean,
Well,
it's
I'm permanently bullish on the Kansas City Chiefs now. That's where I will take. But so so really, okay. Again, using history as our guide, yes, it is expensive right now. We're kind of at the tip of this really exciting new innovation, these exciting new kind of hinge pivot adjustment moments that don't occur all the time in the economy with kind of the onset of the excitement associated with artificial intelligence. And so yes, valuations are stretched. So there's really excitement of what this can do. But again, take about it wasn't that long ago when we were stretched more than this during the last tech bubble boom.
There we go.
Again,
You
and
see
so
it up
there it is.
here.
It was higher than
Yeah.
there. And yes, did it get scary? Did it get dark for a moment after that? Absolutely. Markets collapsed. But again, even that, even if you invested all your money right at that peak and kept calm and carried on, the markets find a way. Yes, you have these dislocation moments, but these almost cleansing moments. Again, it wasn't, people were excited about the internet then, like they're excited about AI now. Internet changed all of our lives, a lot of it, better or worse, it didn't end up changing, but there was irrational excitement. But still, the markets found a way. Again, investing in the S&P 500, you've made a ton of money since then. If you threw all your money in Cisco or whatever the Nvidia at the time, or pets.com, socks.com, again, you're gone because you chase the individual position. So yes, it's overvalued now, but it's not anything the markets haven't seen before. And those that keep calm and carry on continue to be rewarded. The traders get stung.
So the big question, right? And that's the right lesson. And what the takeaway from this is what I always say. Number one is it's more important to be diversified if you have one area of the market that's showing an extreme valuation. So the answer back in 2000 was not to, I'm not going to invest in anything. It was to make sure you have exposure to small caps, to value, to things that haven't been working, international stocks, right? And then we saw that transformation over the next 10 years where those things actually did well. 100%. I'm not expecting the same thing to happen in the next 10 years. It's always different. There'll be a difference, but that should be the number one takeaway from investors. But what I want to focus on here is this: the excitement. Are we at that point? It doesn't feel like 2000 just yet, but it feels a little frothy in terms of the expectation that this is all going to work out and work out pretty quickly in terms of these companies are spending this massive amount, Jamie, massive amount on AA. Look at the biggest companies, Google, increasing CapEx 91% over the last year. Microsoft 55, Amazon 54. You're talking about huge billions and billions of dollars. And so far, it's really been a zero-sum game. It's all gone to NVIDIA in terms of the bottom line, right? Now, the expectation, you could see here, just the hockey stick, NVIDIA, it's almost laughable. We've never seen this type of increase, right? For a single company this quickly, this fast, this magnitude that we've seen in NVIDIA. But here's the expectation. So here, people that are saying, don't worry about this valuation. This is what they're arguing. Tell me if it makes sense. They're saying that the earnings expectations are going to be correct. And this is what S&P 500 operating earnings, this is what they're expected to do between now and the end of next year. They're expected to increase 25%. And so to me, it comes down really to that. Are we going to see AI play out and start to drive the bottom line this quickly for these big tech companies and other companies as well? But really, the big driver and the big spend has been among these big technology companies. What would be your best guess? Do you think 25% can, I mean, it's certainly possible. Do you think that's a sign that investor expectations have simply gotten very high? And because they're seeing this unbelievable technology, game-changing technology, and they can't effectively evaluate what that's going to mean in terms of earnings.
Yeah, I mean, you hit the nail on the head, Charlie. When there is this game-changing dynamic, unfortunately, there is just that irrational exuberance, and that's what people called the last tech bubble, the irrational exuberance associated with it. And so some of these things, they really are priced to perfection. AI better pretty quickly be able to, brush my teeth, comb my hair better. I don't even comb my hair better now, and be the panacea of all of our problems. There's probably for some of these things to justify their valuations. And again, personally speaking, oftentimes people say I'm an 85-year-old man trapped in a 45-year-old man's body. I just don't like to, spend my life on the internet out here. But like one time, I actually looked it up via one of those that you limited. And it just flat out just gave me bad information and something very, very straightforward. And so again, they're making a lot of progress, But some of these ones that are priced to perfection, that's really in question. Things better work out pretty perfectly. But the broader application that actually has excitement, more spread beyond them, traditionally, how it can make the Walmarts of the world's slightly more efficient in this element of accounting. The abilities to kind of create more efficiencies by some of the more perceived as kind of mundane tasks of just standard businesses. That's I feel like that could actually have the likelihood of that having legs is higher than some of these things that are priced that things better work out absolutely perfect.
Yeah, you said it best. Price for perfection, and what people don't anticipate is the environment changes, right? So, not only in the late 1990s did companies overinvest and overspend, but then all of a sudden they have the recession, right? In 2001, there's a big slowdown in terms of business spending, and then all of those expectations are have to come way down, right? So this is all assuming, I think, the best case scenario, so possible, but highly unlikely. And I just say, Jamie, when you're spending this massive amount of money this quickly, and essentially they're saying they're doing it because they have to. If they don't do it, they
Yeah,
can't. They have
they're
no
they're all
chance.
saying that. What they're saying, the answer is however much the spend is, the answer is more.
More, right. So
Anytime there, everything has its excesses. You can't have more chocolate all the time. You can't have more champagne. Like, yeah, you got to be when the answer is just generically more. That's when you do have to be careful because there's usually limitations on anything. But that's where that's kind of arms race to invest in this spending right now.
yeah, and I'm not discounting that they might need to do it. What I'm discounting is when you're spending that much money that quickly, you can't really evaluate what it's going to do for your bottom line. Like how could you essentially say it ramp it up this quickly and say it's going to contribute X amount to your bottom line? You can't, right? And then the other thing is how quickly does it become obsolete? Right, like you're constantly here. Like the next Nvidia chip is always coming out. Then you're like, when do you have to buy that one? And these things, as we know, are super expensive. And so that's the other risk that simply they're too early in investing in this technology, and it continues to improve so quickly that the money they spent just 6 months ago is already behind the curve. They have to continue to do it. So I don't have all the answers. I just look at expectations when they get frothy, when they get bubblish like they're feeling today. Almost always the reality comes in below it. So we'll take a look back next year, you and I, Jamie, and we'll replay this video and see if
You know,
it comes through. All right, because
next year could be 2001, the bomb of a tech collapse. But again, you measure
or
success in
well,
decades,
or it
not
could be you
days.
mentioned irrational exuberance that came from Alan Greenspan, and people often forget that was in 1996.
Yeah.
And the bull market was up in 1997, 1998, 1999. Didn't peak until March 2000. People forget that part of it. They remember the irrational exuberance and they forget that, yes, it was irrational, but then it got way more irrational
Stay
before it
invested,
ultimately
stay
crashed.
diversified. Yeah.
Okay, let's talk about reaching for yield here. Kind of related topic, Jamie, because you don't tend to see credit spreads very tight unless valuations are high. So exuberance in the equity market, we know what it looks at. It looks like it's higher PE multiples. In the credit markets, it's tighter spreads. And what this simply means for anyone watching this is, what are junk bonds? What are the riskiest bonds out there? What are they yielding above a risk-free treasury of a similar duration, which is about 5 years on average? And right now, we're at 2.89%. And historically, that's pretty low. We haven't seen that since June 2007. Of course, Jamie, you were around in 2007. You probably remember what was going on in the credit markets back then. And just like today, you had this kind of mentality, I would say, where the expectation is we're going to have very low defaults, the economy is doing very well, and this behavior of investor where if there's not going to be any defaults, I might as well reach for yield a little bit, especially with the Fed now cutting interest rates. I'm not getting as much on my cash. What do you make of credit spreads?
Yeah, like you said, it's almost the same talk track, 25 years ago. It's just the fallacy of presuming current conditions are permanent. Again, the only consistency is change. and that they're not going to stay at these levels. Could they tighten more? Absolutely. Could the consumer continue to be very strong? Could defaults continue to be low? But pretending for a second that this is where it's going to stay is fool's gold. And really, again, chasing, getting more aggressive on the fixed income side in the public markets is not what we recommend. Take your risk on the equity side, broadly diversifying the exit. You'll be rewarded more over the long run. Don't invest in high yield bonds that were, they were called junk bonds until they figured out, not calling something junk is better for selling something. So take that risk on the equity side. Yes, the spreads are tightening on things that are a lot more aggressive relative to their risk-free peers. And so the false narrative that it's going to stay this way or even get better that happened right before the global financial crisis. We're not saying it's going to happen tomorrow or the next day or the day after that, but we know it's just not going to stay the same. And make sure you're putting your risk units in the right elements that are actually going to more optimally reward you. And we believe that still is dramatically tilted to the equity side for adding risk to a portfolio.
So let me ask you in terms of default risk, right? So this isn't happening in a vacuum. I think you only get to these tight spreads like we saw back in 2007 by defaults being relatively low for a long period of time. So people get complacent and they say they're low, they're going to stay low. And really, like 2020 was very quick in terms of, yeah, we did see a pickup in defaults, but it came right back down. It wasn't like a traditional recessionary credit cycle. So really, we haven't had that since 2008, 2009, that spike in defaults higher. I think that's what's driving it. Our investors are essentially saying, like, there's never going to be a default cycle again. Like the way I was taught and the way I look at it is the best time to take risk in the credit markets is not when spreads are tight. It's when there's defaults are right there in your face and everyone thinks there's going to be a lot of defaults. Back in '08, if you can believe it, Jamie, this was at over 2,000 basis points. So 20% above. That was the spread above treasuries was the yield on high yield bonds. So you could have had like the Great Depression type defaults and you would have still been okay buying these bonds at those levels back then. Today, the problem is, again, that concept of price for perfection. If you have any type of normal default cycle, all of a sudden that excess yield gets wiped away in terms of, okay, you think you're getting that extra yield, but it's gone if spreads widen from here and you start to see defaults.
Yeah, I mean, never say never again. Maybe one of the worst James Bond movies ever made, but it's a great title. Just never say never again, because things have a pattern of repeating themselves, and when you let complacency set in and become unaware of these risks, that's when a otherwise sound investment thesis is disrupted, and it's actually not a sound investment thesis at that point because you're assuming something it can never happen again. That's actually happened again and again and again through the course of history. Really, the global financial crisis, that was that real scary moment. I mean, the darkest moment since the Great Depression. So that was a real calibration with some kind of like, kind of credit standards, right? The end of the ninja loans, or at least deterioration, the no income, no job, but you're still approved loans. And so that kind of has had like kind of a multi-decade effect. Just because it's been a little bit longer time period does not mean it's going to happen. It's going to cease to happen again. It will absolutely happen again at some point.
There'll be a different catalyst, different reason. And so I just broke down here before we move on to the next section what has happened historically. All right, on average, when you have the tightest spreads like you do today, tightest 20% of credit spreads, where you tend to have below average junk bond returns going forward, 4.9% per year versus 10.9% when you had per year when you have the widest spreads. And interestingly, equity markets, you see something similar here, Jamie. 2.9% for the S&P 500 going 5 years forward. When you have these tight credit spreads, when you have very wide credit spreads, as you might imagine, S&P is usually down. It's usually in a bear market, and you tend to have better valuations. So probably no surprise to see much better stock return. So when the news is very good, spreads are tight, it's actually a worse time in general for investors. Now notice here, I'm talking about 5 years, because what happens in the next 6 months, no one knows. If you look at the next year, there's no predictability in terms of valuation for the stock market or for the credit market. So what I would say right now is just be prudent in terms of your risk exposures. Take a good look, make sure you know what you own and why you own it, and don't assume these low default rates will be here forever. Okay, number 4, rise of the bond vigilantes. Jamie,
Huge.
this has become my favorite chart of late because it's just absolutely unprecedented what we're seeing in terms of national debt. In the last 3 months, here's the stat of the day: $850 billion increase in the national debt in 3 months. And I'm just showing you here the federal budget deficit over the last 4 months: 347 billion, 660 billion, 244 billion, 380 billion. And my message was, don't try this at home, because of course if you did, you'd be in a lot of trouble. But the US federal government has no problem doing it, and it's accelerating to the upside. And so how does this tie into financial markets? Well, what we've seen in the past month, since the Fed has cut interest rates by 50 basis points, is long-term bond yields are actually going higher. So this bond vigilante is this concept, Jamie, that bond investors are not going to stay around. They're going to sell their bonds because they think inflation is coming, and there's just a lot of supply of new government debt. What do you make of this theory and what's been going on, interestingly, in the bond market? You don't typically see this after the start of a Fed interest rate cut.
Well, yeah, I mean, I grew up right next to the farm Jesse James grew up on, so I'm used to vigilantes in the area. But yeah, I mean, it's a concern. I mean, really, first off, taking the vigilantes out, circling back to
Yeah,
the debt
let's go back to
dynamics,
that.
what's really, I mean, that's why, yeah, they're forcing interest rates higher. But part of what masked a lot of this insane level of spending that both sides of the political aisle are doing it too. So it's not, what masked a lot of it was interest rates being very, very low. And so again, trying to kind of get back to that is this key narrative. And yeah, it's a challenge, for being the parent of my wife and I have 3 young kids, the kind of debt burden we're passing on to them. It's scary because again, you're able to write checks that you'll never have to cash. Again, it's someone else's issue, gladly paying Tuesday for a cheeseburger today. What's interesting though, Charlie, saying don't try this at home. I agree. Yes, we'd be kicked out of our house, but even further, don't try this overseas. Even worse, the unique thing we have is the United States' unique position as these global reserve currency. So that allows us to get away with some fiscal imprudence that other countries cannot, because so much of the global economy is still tied to the U.S. dollar. And you say, well, what about petrodollar or the BRIC countries coming together? That's eventually that'll change. Who knows? It doesn't appear like it's any time around the corner. So in a way, our unquestioned position as a global economic alpha dog actually allows us to make these really poor fiscal decisions longer than anyone else. But yeah, we need to get it under control, but it's just not there right now. It's a very troubling thing for any of us to have young children that are
Yeah.
gonna pay the
We're
pay
essentially borrowing from their future so we could spend money today. And let's be honest, it feels good, right? It feels good because there doesn't seem to be a cost just yet. And so the argument I keep making, unfortunately, is this doesn't, if you listen to the debates or you listen to a lot of the interviews going on, this doesn't seem to be a top 5 or top 10 issue. It's not even addressed. They talk about inflation, like that comes up in every discussion, but no tying the national debt and deficit spending to inflation, which is a huge, obviously, gap. Like they are interconnected 100%. So break-even inflation rates driving higher, right? So that's driving it. And what we've seen in terms of mortgages, everyone was hoping, okay, mortgages are going to come back down. Well, guess what? Mortgage bonds are long-term instruments. They're more tied to 10-year and 30-year yields. The Fed can't control that. For now, the Fed is not buying mortgage bonds. They're actually letting them roll off. And so what we have is the 30-year mortgage bond actually going from 6.11% up to 6.92% since the Fed has cut interest rates. Now, is this going to continue at this pace? Well, it all depends on what happens with inflation expectations and what happens with those longer term bond yields. This is obviously a very rapid move higher. So if it did continue at this pace, I think you're having a problem on your hands. And I think the Fed then, Jamie, is going to very quickly start to back off. Like, I think the next meeting, it's a done deal because they've said too much already, like to stop. They did 50 basis points and they're saying it's like we got to rush into this. Now the market's saying 25 at the next meeting. And if you listen to every Fed voting member, they're kind of on board with that 25. So I think that's a done deal. But after that, it's been very interesting to see the shift here in the curve. So right after the Fed cuts interest rates, you had the market saying we're going to end this year essentially with 75 basis points more cuts, and then next year under 3% at 2.85%. And this is where we are today, looking at 50 basis points more in cuts being priced in, and then next year 3.44%. So kind of a big jump up there with the market getting a dose of reality, saying perhaps the Fed isn't going to be able to be that aggressive over the next year. And where do you come down in terms of the Fed? Do you think they should have done 50 basis points? Do you think they should continue cutting interest rates despite the fact, my favorite chart here, that it's not 2% inflation? We're 11% above the 2% inflation trend. It's just 2.4% over the last year, but that doesn't mean cumulatively we're at 2%. We're nowhere near it. We've been running at 4.2% since January 2020. So are you a Jerome Powell fan here? Do you say he's doing the right thing? Do you think they should continue to cut interest rates? Tell me how you really feel.
I don't know if I'd call me a Fed fan.
Is that I saw a poster of him back there. That's not
relative to my colleague on this podcast. I guess you'd say I'd be more of a fan. I don't want to blow them up, maybe like you have, but really over the long run, yeah, they're in the short run, it starts to firm up pretty tightly what they're going to do. It was very interesting. Actually, the frightening dynamic over this last rate cut, the markets didn't know until the last day if they were going to do a 25 basis point cut or a 50 basis point cut. And there was actually, there wasn't a uniform opinion. For the first time since 2005, the Federal Reserve, all the voting members didn't just arbitrarily agree with each other with whatever they did. That within itself is kind of frightening groupthink that has been essentially 20 years since they didn't all objectively agree on the exact same thing, because they don't know any more than anyone else. So in the short run, yes, they're going to continue to lower. But over the long run, again, their crystal ball is just as accurate as my 6-year-old on the wall back here. They don't know what tomorrow brings. Just like they're humans, just like the rest of us.
They're guessing. They're throwing darts. Yeah. They're guessing with perhaps the most important thing in the economy, which is the level of interest rates, which is why they shouldn't be allowed to set them. We should let the free market set the market. Jamie, we have 2 more topics, so I'm going to let it go. But do you think the Fed cuts 2 more times this year as expected?
I would say, yeah, the data is saying that as we get closer to it, then it actually puts them, then they get to actually prove true what they said they were going to do last year, which was actually completely unnecessarily, in our opinion, to actually say, we're going to lower interest rates 4 times in 2024. So there's actually that silly subjective dynamic to it, that they can say, okay, we've achieved that objective. So that within that case, bring in the silly human element to things. If you're just asking for my opinion, sure. I think they do it so they can say they were actually accurate last year when the trend line of this year was absolutely nothing like they anticipated, nor Wall Street strategists that got paid too much to get it completely wrong with the markets.
Yeah, I think that's probably right, because they're just really literally looking at that year-over-year inflation level, and if that stays in that range, they're going to be comfortable moving the rate down. And what I would say, just lastly on this topic, watch that money supply, because all of a sudden here, Jamie, creeping higher, 2.6% over the last year. We do not want to see what we saw a few years ago in terms of the money supply. So they got religion, the Fed. They realized we can't keep printing, but now they're back to printing money. And the question is, with all this debt being issued, are they going to start printing money again? I don't have that answer, but my guess is this is going to continue to move higher. Hope it doesn't, but my guess is money supply is going back up. Okay, stock picking is hard. Very quickly here, Bill Ackman, 2022, sells his Netflix stake, takes a $400 million loss. Pershing Square, that's not enormous, but for most people, that's an enormous loss. You could see where he bought Netflix, where he sold it. Essentially was saying, they were making changes to their saying they're going to incorporate advertising. They're going to have an ad tier. They were also, if you remember at the time, they were going to start cracking down on passwords sharing. And the worry was that a lot of people were going to leave Netflix. Fast forward to today, Jamie, what actually happened? Netflix up 250 versus 38% gain for the S&P 500. It's back at all-time highs. This is no knock on Bill Ackman, in my view. It's very difficult to get it right. And what did they not foresee? Well, actually, that crackdown in password sharing, people signed up, a lot of them. You're a Netflix subscriber, Jamie?
I am. We actually have an iteration that we can have two separate versions of it. I think I'd be excommunicated from my house if I tried to eradicate our Netflix subscription.
So there you go. A lot of people have become reliant on it, and they're not going to cut that Netflix subscription. You can see here the growth. They had a big growth on that lower priced ad tier, and revenues, which were slowing down back in 2022. You can see here they accelerated again to the upside. And guess what? They've been running the company pretty lean here. Profit margins are at record high. So I know we have one more topic and you got to run. So I want to get to that. But really just what this tells me, stock picking obviously very hard. And just when you think a company is down and out and Netflix was in this enormous drawdown, everything changes and it comes roaring back.
Just because someone's famous and they have articles written about them all the time, again, they can tell the future just as poorly as anyone else. And
right.
so
and regarded as one of the best investors. So if he can't get it right, very difficult for the rest of us in terms of stock picking. Okay. I want to end here, as we always do, with something positive. I'm going to ask you a question, Jamie. Are workers today better off than 50 years ago? Inflation adjusted in terms of their earnings.
Well, again, from the rhetoric, again, it's political season. People always asking, are you better off than 4 years ago?
Yeah. Forget about 4. That's a tougher question.
50 years ago, I don't know. What's the data tell us, Charlie?
Okay. So the reason I'm bringing this up, I saw this on X. Bernie Sanders was on Lex Friedman podcast, and I guess he asked Lex, is real inflation and counted dollars making more money than 50 years ago? The answer, no. Right. So he made this argument. Did he show any data to prove that, Jamie? Of course not, because if he did, this is what he would have shown. This is the last 50 years, real median personal income in the U.S. up over 50% in the last 50 years. Pretty darn good. So most people, their standard of living much improved over the last 50 years.
The advances in healthcare, the advances, so many other things. Again, we're so lucky to live in the time we live in. It's great that the data, instead of the rhetoric, supports that.
Yes. So Bernie Sanders, who honeymooned in the USSR in the 80s and has talked fondly about Cuba and these other countries, we're much better off, Bernie, being in America compared to the last 50 years.
Here Comes the Sun is your favorite Beatles song, right? His is probably back in the USSR. Safe to assume.
That would be my guess, but we'll have to let Bernie answer that when we bring him on the podcast at some point. But I'd love to just see who was advising him to post this on X, when it's right away you could just see a million people saying, look at this. You could show the charts in 20 different ways. The incomes are obviously adjusted for inflation are much higher today than they were 50 years ago. Okay, with that, Jamie, thanks so much for jumping on the Weekend Charts. Thank you, everyone, for joining us. If you're all watching this on YouTube, take a moment, hit that subscribe button, leave us a comment. I read all the comments, try to respond to as many as possible. Have a great weekend, and we'll see you next time on the Weekend Charts.
Yeah, thanks, everyone.